again, and that is for those who are happy to and able to switch on their videos, that will be great. It's always nice to have a live audience and that I'm not only talking to Malavan. And so thanks for being on today. I'm going to have sort of the briefest introduction to the topic, to myself, and we'll sort of dive in right away. So let me just get to, okay. There's always the operational risk you haven't counted on, so. Okay, and. So just a quick maybe nod by those who are on the video or something can just tell me with a hand up that you can see my screen. Thank you, that is perfect. And I presume audio is good. So wonderful to be here on this interactive session as Malavan has requested. Please do jump in whenever you would like to. Not just questions. I think looking at the people who've joined us today and the experience on the line, I actually think there would be valuable contributions as well. So whenever you would like to add a point, to make a point in addition to the discussion, I would really appreciate that. The idea is that all of us get the benefit of not just my little knowledge, but around the room, as it were. So today, sort of the focus of this thing was, we were thinking of what we could call it. And essentially, we could have called it anything like this. And if you get the message, we're trying to make this an applied operational risk discussion. Not theory. We're not going to look at too many definitions, or for that matter, not really go into any definition. But over the years of things that I have seen, looked at in multiple organizations, in multiple geographies, what can I distill from that, and what is that discussion we can have, trying to make this as real a discussion as possible for you at work. I guess it'll only be fair for a bit of background. Usually when I introduce myself to people and I tell them I'm an accountant and a banker, they usually ask me to go get a real life. But that is who I am. That is my background. A chartered accountant originally and a banker. But the reason I became a banker, and when people get to know that, there's a sigh of relief. It's really more about the passion for people. And I think as we go through today's discussion, and a lot of you are operational risk people, and all of you must be familiar with basic definitions. This is all about people. A large part of risk management is, in the democratic sense, for the people, by the people, of the people. So that's my background. Now, where did I spend my time, or where did I do my time? It's essentially with three banks. HSBC, the beginning of my career, ABN AMRO, the middle and the longest part of my career, which is part of the reason why I'm now sitting and talking to you from the Netherlands. That's where I spent a lot of time and now reside here. And Bank ABC, or what used to be called Arab Banking Corporation, headquartered in Bahrain, a truly multi-regional bank. And what did I do? So I started out with HSBC, and I spent a lot of time, the initial years, in operations, so front office. HSBC was the first bank to computerize in India back in 1984. We were involved in that. In the communications room, in the trade finance departments, before moving to relationship management. Left India to go out and explore the world, joined ABN AMRO in the UAE. Spent 8 years in the UAE with ABN AMRO, became head of corporate. And then for my sins, ABN AMRO moved me to the Netherlands, where I joined the risk department, credit risk, looking at proposals now coming in from all over the world. Towards the end of my ABN AMRO stint with relationship management, I became the chief risk officer of what is the transaction banking business of ABN AMRO, very heavily focused on operational risk. This was the trade finance and payments business of ABN AMRO, of quite a few $1 billion in revenue. That was the size, 60 plus countries. ABN AMRO got taken over by RBS Santander back in 2008 and 9, and 2010 I left to explore new adventures, find more excitement, and I joined Bank ABC in Bahrain, not knowing how much excitement I would get through the Arab Spring and all of the fun that followed after that. There, as the group chief risk officer, it was looking after all the whole risk portfolio. So that's been my journey, half of it in the front line and half of it in risk management. What has been a passion all through my career has been learning and development. I have taught at the academies at ABN AMRO. I taught for a couple of years. At the end of my banking career, I joined Moody's, the learning solutions division of Moody's, looking after their Middle Eastern business for just under 2 years. And now that's what I do on my own. It's about risk management. And now it's still about people and education. So that gives me some credibility to talk about some of the things and little experiences that one has gathered over the years. And just a quick snapshot of what we're going to do today. Scope, definitions, challenges. Do not worry, we're not going to look at definitions. We're going to be just thinking about the way we define that. Is that how it should be defined? What is the scope? Why is it getting so much attention? Why are we talking more and more about these risks? And then my proposition to you that ultimately it's ownership and partnership. No matter how you look at it, at the end of the day, that is what's going to drive success in the organization. If you're in the risk business, that is what you need to know to get people on board. And if you're on the business side of things, you have to collaborate with the risk and take ownership to make things work. We'll talk about governance. We all hear about first and second and third lines of defense. But I will talk about how governance segregates our responsibilities, but should encourage collaboration. And then we're going to look at examples. At the end of the day, does operational risk help the business? Because if you don't, it is a losing proposition. So my proposition is it does help the business. And how you help the business, how do you make business or frontline people, whether they are relationship managers or in operations or in HR, how do you get them to see the value of doing this? And hopefully all through we'll be able to talk about examples. I will provide some. And if you allow me, I might come out to you and ask you for some examples. Does this make sense so far? Is there anything before I dive into it? Thank you. And as Malavan said, do unmute, do speak. If I can sort of see some movement, I may stop and ask, but intentionally, we will never ignore you, okay?
Sorry, Vijay, I need to make an announcement, which is, I completely forgot. Guys, if you're not participating, then we will be forced to charge you, by the way.
So I'm the only one who's here for free, clearly. Excellent. Okay. So let's start with a few things. If I was to put out this today, what would this trigger in your mind if I just said PPEs?
Corona.
In the context of where we are, absolutely. And for some of us in the audience, if I said PEPs.
Politically exposed
persons.
Politically exposed persons.
Would be the kind of people Seher enjoys talking about. And if I said PPSE in the context of operational risk, what do you think I'm talking about? So this is, and I just give you a few seconds. Anybody wants to shout out? So this,
I think it's people, process, systems, and external events.
Sibu, that's right. Thank you. Yeah, this is people, processes, systems, and external events. The classic definition of operational risk that hasn't changed for years. It's how you look at it. And I want to raise this in the beginning. That's the only definitional discussion we will have. But perhaps the most crucial, because what is happening as for the last 15, 20 years, we have been running with operational risk and developing the most magnificent dashboards and coming up with great metrics and doing a lot of work on communication, but losing sight of some of the basics. And the strongest operational risk organizations are those who understand what is coming from people, what is coming from processes, from external events or from systems, and mitigate those risks. Mitigation, much more important for inherent good quality operational risk. So this was just to say, okay, so this is, as we all know, the basic definition of operational risk. But defining operational risk, now let me ask some of you who are in operas, what is in your operational risk world? So just to take anybody in an operational risk role, typically what is included in your operational risk agenda in terms of the types of risks? Just a random example or two, please.
Process-related risk.
Which is from the definition, yes. But okay, maybe I'll throw it out in a different way to you. How many of you, maybe just a show of hands, how many of you would actually have fraud in your operational risk world?
Me.
Some
We do have.
Thank you. Yeah. And in some cases, as I say, fraud sits in a different part in what is called financial crime with compliance, but not in operational risk. Now, very often we tend to narrow our vision of operational risk to what the departmental or organizational structure says operational risk is. So the question really is fraud in or out? Is business continuity in or out? Is IT or cyber in or out? And there's a lot of these things that, for various reasons, banks have their own good reasons for segregating this. But I think for us to understand, and for my proposition in today, when I talk of the business and risk alignment, you really have to look at the world of non-financial risk. So classically, financial risk, much more prevalent, much more talked about, classically including the three things of credit risk, market risk, and liquidity. Now, in this thing, let me just stop this for a second and come out to you guys and say, so when you think about in your own organizations, what is the biggest risk you have? And I'll just take maybe one or two answers from different people. What is the biggest risk in your bank? And I don't need to know a particular name of a customer or a person or something. I just need generically, what would you consider the biggest risk type in your bank?
It's money laundering plus fraud and systems.
So money laundering and fraud, I picked up the first two. Thank you. Ashish, will you speak?
KYC?
KYC, so back to money laundering. Anybody else? Varsha?
The risk of cybersecurity attacks on businesses, especially banks.
Absolutely. So now,
I believe information security and information technology related.
Okay.
I think it's reputation risk.
Reputation
risk.
Also legal risk.
The last thing I didn't hear after reputational risk, please.
Legal risk.
Legal risk. So let me ask you, because we are talking operational risk, it is interesting, but also in a Middle Eastern audience, having worked, I think I have spent now about 14, 15 years in the Middle East as well. Nobody mentions credit risk Now, I'm not sure if that's just because we are talking operational risk and therefore you have kept it to that. But traditionally, there was never a doubt about everybody was very primarily focused, driven by credit risk. And if I was to say what's the biggest risk on your balance sheet from a capital point of view, then I guess there would be more inclination to say credit risk, because the way we work, the biggest way, the most familiar territory, the best measured, where we understand the measurement for many years, has always been credit risk. But today, when we look at non-financial risk, and I really urge you to make that distinction and not narrow it down to operational risk the way your bank defines it, you should consider the world of non-financial risk as we talk about our examples on how we can facilitate better synergies through collaboration between business and risk. But are we okay with that concept that while on the balance sheet, credit risk may have the heaviest capital allocation, operational risk is increasing, and every category that you have mentioned is fairly large, fairly significant. We've seen the numbers coming up in the papers, and absolutely right, all boiling down at the end of the day to the one thing that you mentioned, which was reputational risk. So whether reputational risk is the culmination of everything or not is an eternal debate. We'll skip that for now. But that is the point I was making. Now, let's go back to so what are the challenges as a result of this?
Before that, just a question.
Yes.
We hear from papers of many big incidents of operational risk, but is it the importance of operational risk really changing on the ground in organizations? Do you feel, because I have worked with like 3-4 organizations,
yeah,
I do not think it is given equal importance.
Absolutely. So perfect. So Ganesh, you are not going to pay for the seminar. You've been ticked off that list. Excellent. So that's the first. Now, you actually touched on one of the core things that I will be talking about, but let's deal with it here and now. So clearly, and that was the point. So credit risk has been so predominant in our minds, and just that you have a battery of relationship managers who are motivated to lend, who are motivated by bonuses. That is what it is. It's lending, lending, lending. You then create a risk organization to counter that. That whole ecosystem was so focused on credit risk that operational risk was, and we can use any phrase we want, the poorer cousin, the orphan, whatever. Operational risk, and I'm using a cliche, is not new. Operational risk is the oldest risk in any organization, not just banks. But it has become the biggest, latest, most talked about, most attention grabbing risk when I talk about non-financial risk today. And the point that I would want to raise or ask is, why do you think this evolution is happening? Why do you think non-financial risk is getting attention? Or for that matter, why does anything get undue attention?
Because the mere size and even the viability of an organization is in question. You may do a credit loss on a particular customer. Your going concern is not at stake. But in the kind of incident that we have seen, the going concern itself could be at stake.
Fine. Any other views on what drives this?
Continuous change in the environment. The way we function is absolutely changed over a period of time. Maybe a couple of years back, it's morely manual driven activities. Compared to today, we want everything to be digitalized, and any digitalized or any new function which is getting involved, it will come with its own inherent risks associated. Definitely you need to think beyond certain things and address it.
Okay. Take another view from the audience.
And also systemic risk. Now your risk is not local, it's global.
And some banks are more affected and some banks create systemic risk, and that's another discussion. But so I would put forward two things, unless anybody else wants to shout out something else.
So I think that
Yes.
organizations are starting to see those risks materialize now. Incidents are occurring. And when they're starting to unpick the root cause of those incidents or risks materializing, they're starting to realize that they should have put processes in place or understood their processes and mitigate risk more closely. Take COVID, for example. It's an external event. Everyone's having to respond to it now, but they're on the back foot because they hadn't anticipated such an event occurring.
Correct. So starting from that, just that point, they hadn't anticipated, or anybody who had done business continuity, disaster recovery as a tick the box exercise is now at the wrong end of the stick. So a lot of, some of the biggest problems with banks, in my sort of humble opinion over 30 years, is the banks would not, it was rare to see a progressive bank. These are big monsters that move slowly, and usually what drives them is regulation or some threat of getting wrapped on the knuckles. So the number one thing that's happening today is bad news. There is bad news, and nothing gains attention more than bad news. And this is the point that you all are making. It's happening, it's hitting us hard. The numbers are large. So clearly we are waking up to that. And I think that with the fact that anything that happens is known to everybody, and I'm exaggerating, but anything is known to everybody in matter of minutes. That's another thing. Previously, long ago, and some of you may not even have been born, but if you take the old Barings Bank collapse and what happened, by the time the facts came out and the banks decided to do a lessons learned from the events, that took a year, or some banks took a year and a half to get their act together to respond to what had happened in that bank. Today, things happen, bad news travels the fastest. And I think that is the prime sort of driver behind why this is gaining such magnitude. And when you have so much of bad news, the regulator gets more and more involved. So the banks have time and again shown that self-regulation is not their strength. Self-improvement is not their strength. So they wait, either you have the bad event or you have the regulator jumping in because of the bad event, and you all start to get your act together. So that's a bit of why this is happening, but there is no denying the fact that there were things happening in the past. Even if you take credit losses, a lot of credit losses, and I'm sure you will agree, stem from an operational risk event. It's not always just a series of bad business risks that have led to the downfall of a company. You could have a breakdown in the way we deal with companies, in the documentation, in the way we've structured it so that they are able to take advantage and build a whole sham set of transactions, and the bank suffers a loss. The company may still continue, but we are unable to recognize that. So a lot of these things have added up today to come to this point of bringing us there. And in fact, I'd leave you with one thought now. If you look at the history of risk oversight, the chief risk officer itself as a function, if you go back 20, 30 years, banks had chief risk officers. Not all of them were sitting in the C-suite. Not all of them were at the top. And then came all the big crises, and as the risk managers say, never waste a crisis. Everybody jumped up and the CRO position got elevated. I mean, it was a risk manager or a credit officer, etc. You had different levels, but a chief risk officer came and sat at the top, CEO, business, an equal footing. But what was also happening, most banks, if not all, the chief risk officer was a credit person. He was a strong credit individual. Today, such credit individuals are struggling to manage risk profiles of banks which have everything that you have spoken about. And I'll flash the top 10 risks for 2020 that I just saw the other day, and I'll show them to you later. So there is a movement even in the risk organizations to do two things. Some regulators are segregating credit risk and other risks. So you will find in some regulations in some countries that the regulator has said, I want this split Now, whether it's workload or he argues conflict of interest, I don't want to go into that discussion. That itself can be a 1-hour discussion. But that's one way of segregating. And the other thing is increasingly the kind of person who has to look at risks holistically, or the term we use now, the enterprise risk, really is a new kind of animal. You have to have hands-on experience on the ground. You should have had the credit knowledge and awareness and experience. You should understand operations. You should understand these non-financial risks. But finding one person who clearly is able to be as comfortable in cybersecurity and pen tests, and on the other hand, on current ratios in credit, is not an easy thing. So as a challenge, perhaps today's biggest challenge is top-down. How do you manage these risks? We'll discuss the 3 lines of defense, and I'll come back to this briefly. Does that kind of discussion make sense? Is that, yep? Thank you, Iman.
It's because really that's what's happened now after COVID, and especially here in Gulf and Qatar, we don't used to work with the crisis. This is maybe our second crisis before the blockage. So it makes sense.
Thank you. Yeah. So I think you will see a lot of these changes coming through. I have
just a question before we move on.
Please.
Now, typically given the importance of information security, generally organizations are having a separate unit for information security, which is not under operational risk, because they require dedicated skills and different kind of knowledge and experience. So in such a scenario, how does operational risk also review information security elements? Like, for example, career risk assessment. Does it make sense? We are not doing, because we expect information security guys are better placed to understand and review the information security risk across the board. So we leave it to them, saying that, okay, we are not going to review your part. Same for audit, NHS audit, we don't do. So what's the industry practice, or what's the right thing? This is what we are following.
Okay. Just a quick thing before I answer. The last thing you said about audit, I missed that. What was that? Then I'll answer.
Like control units, for example, if you have to do a risk assessment, we don't generally do risk assessment for control units like audit, compliance, or for example, information security.
Yeah. So, okay. It's a complex thing. So there's many sides to this. I think the primary driver of what your situation, or yours, I mean, any bank situation on the ground, is linked to size and complexity of the business you do. So if you are an HSBC or in 60 to 80 countries with 8 lines of business, with 250,000 people, with huge retail platforms and so on and so forth, that is one complexity. And then if you are a single country, retail only Islamic bank, very sophisticated IT, that will be a certain model. So what I'm going to attempt to answer is not a perfect panacea for all of that. But the point is not, and this was the point I was making earlier, it's not about where it sits, because a lot of what you're asking me seems to suggest that this is an organizational issue. So operational risk, how will they look at IT risk? My point is IT risk is operational risk. It's just that your organization group called operational risk, but the risk framework that you have in the bank should fundamentally be the same. So if you go into the question of identifying and mitigating, or would you do an assessment? Would you do a self-assessment? Would you have a first and second line in IT? Yes, absolutely. There are people who are running with the IT agenda, the people who will implement, who will set up the distribution channels. And then you'll have the risk people who are IT savvy risk people. They'll follow the same model. Whether a bank chooses to put a certain individual on top of 2 or 3 or 4 kinds of risk, depending on his bandwidth, the bank's structure, there's so many other human elements that come into it, is a separate question. But fundamentally, the simple answer is your framework needs to be solid, robust, scalable, standardized, so that across the organization, people are not confused, because you can have retail. Retail will deal with operational risk, and their IT guys, and they will also deal with IT risk. Now, if the two of you are following different ways of naming things, of different ways of doing things or assessing things, this is going to drive the business crazy. So again, in one of the last slides, I will talk about a few tips on how to standardize or how to get this alignment. But my answer to you is, it's not about one part of the bank looking after another. It's, are you structurally performing the same robust risk management practice, which is owned by people in IT and in IT risk? Then you're doing the same thing. You don't need another layer if it's not important. Does that work for now?
Okay, yeah.
Thanks. Okay, and Fahim, I have a question from you, and I'm going to come back to that later if it's okay.
Vijay, we have a question on the chat. Can I?
Yeah, that's the Fahim one, right? From Fahim.
Yes, yes, Fahim, yes.
So I will come to that. I just said, so Fahim's question, I have read. Thank you, Malavan. I will come back to that at an appropriate time. Fahim, you okay with that? I will take that as a yes. Thank you. Okay. Let's try and go back to see what else we could cover. So clearly we've discussed challenges of organizational structure on, where does that ownership lie? And my message to you is that get down to the basics of looking at the people, process, systems, and external events. Make sure you mitigate these, that the best people involved, capable, are doing this. That is your starting point. How it adds up in an organization should be a secondary consideration. So I think this was a discussion, we've already had, thanks to your question earlier, Ganesh, was, the definition is constant. It's PPSE, and it has been PPSE. Why does it appear to be growing all the time? It's what I call the non-financial risk balloon. This balloon, it's been sort of, it's been there in the background, but it hasn't been visible. It hasn't been filled up. Now, this balloon is a big balloon which has risen up. It's in the skies. Everybody's eyes are on it. And why the attention? It's the bad news. Nothing gets your attention more than bad news, which means what gets your attention to do something about it, I have found, unfortunately, is bad news. And the regulators have always said, well, if you regulate, self-regulate, handle it yourself, show me that you are able to look at your own risks, challenge your own risks, and manage them, I am more than happy to back off. So I think that has been the, as an example, an interesting quick story. So when the global financial crisis was over and there was a massive review of what happened, clearly there were many failures. And again, that itself is a two-day lesson to look at. But the regulators came up with what was wrong with the industry, and plenty to talk about, centering around culture and conduct and everything. But the regulators looked at themselves and said, so what did we do right or wrong? And in fairness, they had a good self-evaluation. And one of the things was that, are we really competent to look at everything? So we just had a discussion on IT risk and op risk. So the same thing, imagine a bunch of regulators. Can you have one person who is able to control and foresee everything that 100 banks may or not see or may not have the inclination? Now, one is regulators are driven by different goals, and the banks have different targets or goals, etc. But that was one of the issues. So I think regulators themselves have said, okay, we're not the experts. So very often in the UK, when the PRA wants to conduct a review of the banks, they actually bring in one of the big four. And I'm not sure if that has expanded to more than the big four now, Varsha, but is that now still a habit for the reviews, the 166, and all that, they still use the big four, or are they allowed to go to other people?
I'm not really sure how the regulators are working now. I think they're using mostly the big four, but I've not seen them use other smaller firms.
Yeah, so they tell you that, okay, we don't think this is working well. We're going to come and have a look, and you're going to take help from, and they will nominate one of the experts, where KPMG, Deloitte, or Ernst & Young have expertise, and they have ramped up. So they get them in to look, they come up with their findings, and then the regulator will make sure that you are fixing it, you are embedding it, you are living and breathing those changes. That has how the things have shifted in recent times. Okay, so, so why the attention? We've had that discussion. And the vicious circle of regulation, we kind of just looked at. 3-4 years ago, when people were looking at what are the big risks, they actually categorized regulatory fines, conduct, AML, all of these as the biggest source of risk. It was up at 30-40% of the overall, matching at that time terrorism and a few other things. Now, you can argue these are people who are trying to pass the blame on regulation, but what has happened is the industry is generally frightened of the regulator, which has led to its own set of operational risks, because you have to implement large changes. Every change you implement has inherent risks built in. So there is this vicious cycle that even getting regulatory compliant, if not managed well, will throw up more risks. So it's just that we have to be careful. And just because it's a regulatory change doesn't mean you are forgiven and you are allowed to run with it. No, you need to look at it with the same amount of diligence. Quick snapshot, we are not going to discuss this, but I just felt, talking of non-financial risk balloon, if I go back to 2010, when I moved back from the Netherlands to Bahrain and joined Bank ABC at that time, or when I was in Amsterdam in the credit risk department, there was just the basic noises starting to happen on outsourcing. Some of the big banks have started outsourcing their back offices. And you did look at talent risk, and you looked at theft and fraud. Now you look, and it's got everything that you have been talking about when we spoke the first question. It is all of resilience and data and IT disruption. Some of the biggest problems that we've had out in the UK in the past 3-4 years have been huge IT disruption, affecting hundreds of thousands of customers, if not 1 million or more. And the regulators come up with big fines and so on and so forth. So this is your risk profile. And I'm just building up this picture for a purpose. So you have operational risk, which used to be a limited world, but suddenly this huge thing of non-financial risk is so large. The question is quite simple. So who's in charge? Where does the ownership lie? And so let's have a little discussion before I put up more slides. I have to punish you every now and then by making you look at my face and not the slides. So what do you think? What is, when we talk of ownership of such a large agenda, what are you thinking?
I think the ultimate ownership lies with the board, while the ownership lies with everyone.
Okay. Any other volunteers? Okay, I'll take that everyone, and that's my preferred thing. It clearly the risk sits with, so absolutely accountability with the board, but owning the risk has to be with everyone. So whatever you do for that, you are primarily responsible. So the concept that there's a risk management unit that's going to somehow magically manage everything is the flaw. And a lot of problems that have happened in the past have been because the reliance somehow has always been that, oh, if there's anything wrong with this, let's just rush through with this. If there's a problem, risk management will catch it. Risk management should be looking to make something more robust, to bring in a bit of independence, not be the one where you toss it over and say, okay, you know, because then they might as well just be an extended part of first line, because, you know, their job is not to find fault. Risk management, to me, is, let me actually ask you a quick question. If I was to ask you one word to describe what is the role of risk management, and try and stick to one word, not the George Bush variety of one word, which usually was 3 words. Risk management, one word, what would you choose?
Collaboration between all the departments and institutions.
Collaboration, one word.
Facilitate.
Facilitate.
Hedging.
Hedging, okay.
Partnership.
Partnership, thank you.
Fahim says mitigate.
Okay, so none incorrect. Over years, what people have tried to do to bring out the role of relationship management is saying it should work as an enabler. And I'm just throwing another word, I'm not correcting any of you. An enabler. So if I go back to my role as Chief Risk Officer, right up at the top was, I am supposed to enable the business. What does that mean? I must do things where the business can, create a structure where the business can run fast, where the business is in a safe surrounding so that they can do what they have to do without having mishaps and collisions. I am supposed to take away the element of surprise. It's not like you run, you chase 20 customers, and then you come back and I'm sitting in risk management in the ivory tower saying, no, I don't like this. No, that is not how this works. So as an enabler, you have the ability to independently assess something, but at the same time, you provide this wonderful, so imagine a Formula One, you are designing the tracks, you are designing the gradient, the slopes, the pits, the everything, allowing people to drive at silly speeds. That is my best image of what second line should be doing. So ownership, and I always keep saying, will the real risk manager please stand up? And I agree, this is pretty much institution-wide. And why is that important? So the 3 lines of defense, and we've gone a bit into that, the first, second, third line. I am going to assume that this is something people are familiar with. If anybody would like me to stop, please say so, or just drop a line and I will explain a little more in detail. So the 3 lines of defense, the first line is the front line. Usually people say, oh, that's the business, the client-facing line. But the first line of defense is usually anybody who's actually doing that work. So if it is selling to customers, then it is the relationship manager. If you're in operations processing letters of credit, then the person actually working on the letter of credit is your first line. So the person who so people executing, doing a basic function in the bank is the first line. The second line is typically some of the control functions and risk management who design the framework. So if you take compliance, and Sahar, feel free to correct me later if it's inappropriate. If you take compliance, there is one part of compliance that's sitting up in front with the business and, you know, quickly getting all the data to see the KYC for a client, or things that fall out of a filter, they will check and see if there's anything wrong and see if anything needs to be escalated to the authority internally. But the second line is actually sitting and saying, how will we do this? How is the organization structured? When you find something, how do you escalate it? What is the quality of the filter? Is it catching everything? So the design of the compliance environment, the policies, the procedures, Imad, I think, so you're very much part of that world. So that policies, procedures, creating the framework is your second line. Executing, running is your first line. So, but you can have things like compliance sitting with the business in first line. You can have some credit risk people sitting with the business and writing the proposal, but they're called credit people. Sometimes that may explain some of the nuances within banks. So why is that important? what first line does, second line doesn't do, and what second line does, first line doesn't do. Otherwise, we are running the risk. So if I am allowed as a risk person to go meet a customer, I like him and lend to him and sign off and approve it, clearly that's abysmal governance. So this is about checks and balances. Very quickly, last couple of things. So what are the things that are first line? If you look at operational risk activities, let me just put a few things here. Risk assessments, the change risk assessment, control testing, lost data, or when you have a problem, you want to analyze that, you want to escalate and manage an event. When you look at this, who is the best person capable of doing these things? Right? It's very much the first line. They sit closest to this. They own the P&L for this. They own the client. They own, it's in their interest to solve the client's problem quickly. Say whatever you want in whichever way. This is why they need to do this. Now, second line, as I've explained, will have the framework. And if you do not make it easy for the business or the first line to do these things, you will never get them to do it. I learned slowly but surely the hard way, why are people resisting operational risk? Why is there a lack of awareness? And Imad, this is, Fahim, this is half of the answer to your question. Fahim's question is, how do you get executive management to buy into operational risk, etc.? So the first thing you do to get them to buy in is show them that it's useful for them. And make it easy for them to do, as in make it, it's not about jargon, it's not about complex forms, it's not, you know, that is not what their job should be. It is about the root cause analysis, a proper self-assessment. And so if you can make it easy for them, you have solved half the problem. And I will only say this, that this is half the problem solved, because you still have to have a certain behavior in the individual who honestly steps up to do these things properly. But if you don't give him an easy framework, he's not going to step up. He has an excuse to back out of things if he finds it difficult, complex, boring, intricate, whatever. So you will lose the person. So at least make it easy. Second line is the framework. Third line is the totally independent check, the post-mortem. Anything we've missed out on all of our journey, they will look at that and suggest perhaps further remediation if necessary. So we're coming sort of to the end of this, is to say, let's look at some examples. We're supporting the business, we agree, right? And if a business is looking at a strategic risk appetite statement or a strategy statement, predictability and stability of earning is a key thing, right? Volatile earnings, nobody likes. The shareholders don't like, the rating agencies don't like it. It's just not a great place to be. And then you have capital preservation. To your point that you were making earlier, I think it was Ganesh, was big events, wiping out, going concern worry. So even if it's not a going concern worry, but you have substantial chunky losses, your income just goes up and down. It's like a yo-yo. And the second part is, if we're talking about banks, the business of a bank is to, what would you say? The core business of a bank is to
take money from others.
Lend.
From others, says a suffering retail client. Sorry.
Well, like any other business, make money.
Make money. Sorry, you were saying, Amna, was it? No, who was that? Sorry, I missed a few more suggestions.
Most banks are into the lending business.
Into the lending business. But if I have to philosophically describe a bank, what does a bank do to make money?
The bank usually should contribute to the welfare of the society. It's like a mutual benefit between the the owners of the bank, the shareholders of the bank, and the best advance the society is, the best returns for the bank is.
Spoken like a true forward-looking corporate social responsibility person. And I fully agree with you, which is where a lot of banks have gone. But to the point of making money, and if the bank wants to succeed and even do corporate social responsibility, you do need to make some money. It's very quickly, there are the 3 Ps, right? People, planet, and profits. That is the basis of what you're saying, Imad. So to make money, what does a bank do? What's the basic job of a bank? What does it do? It takes
Provide
risk.
financial solutions.
Provide solutions. So the core business of a bank is to take risk. Do we agree?
Yes, 100%.
Yes,
No
very
risk.
much.
Yes.
Sorry, Amna, what did you say?
100%. We have to take risk, but
Yes.
we have to manage the risk.
Absolutely. So your business, if you don't take risk, you might as well shut the bank. The bank's not there not to take risk. So you don't avoid risk as a bank. You avoid risk if you can't manage it, to Amna's point. So your business is to take risk in the first place. So there's no avoiding risk. And then we come to the question of managing risk.
I have something to say here, Vijay.
Please.
The best way, I'm talking of, in principle, the 3 lines of defense are the front line, the second line is your compliance unit, and the line is audit. But I would say that the best way of managing risk is where the second line works closely with the first line, tries to understand the processes they are following, reworks their control framework accordingly, and assists the first line in identifying risk effectively.
Fine, guys. The session's over. She has summarized. Thank you. Absolutely. That is very much the point. The whole purpose of second line to enable, facilitate, and collaborate. Spot on, sir. I totally agree. So
thank you.
Coming back to the risk point that we were looking at and extending what you all have just said, it's not about risk elimination, but management of risk. So why do we have a risk strategy or a business strategy? It is basically because you will have to manage those risks, right? And you have to eliminate surprises. And you have to balance too much risk and too little risk. That's the game that you were playing. And operational risk can be punitive and prohibitive, or credit can say, we will not lend to anybody whose name starts with the first 26 letters of the alphabet. And that's fine. Then you know exactly where you stand. But not making money and being outlandish, lending to anybody and everybody just because you can make money, is not what this is about. So let's just look at, we're going to take 2 examples, a payments example and an exchange house example. And I'm taking a payments retail. All of us make payments, right? We make payments online, we make payments, forms, whatever it is. So let's take a payments example. In your payments example, when you sign on and you go into and you're going to send money to me, right? That's the deal after this thing. You're all going to send money to me. You log into your bank and you were saying, oh, new beneficiary, because I don't remember getting money from anybody before. So you say new beneficiary. Different banks deal with this differently. So what do you think? What's the first thing that happens when you create a new beneficiary? What happens?
You put in the beneficiary details.
And?
Then you get an OTP.
And, okay, and
that's a control.
Just the last phrase again, Jomi, please.
That's the control.
That's the control.
Yes.
Are you then able to make the payment the same day?
Yeah.
Okay. Hold that right there. Anybody else? Anything different?
The name gets searched against any AML checks. Basically, it's a serial number or any other such things.
Yeah. So you will find banks. I have 2 banks, and one does exactly what you said, Jomi, and it allows me that, and I'm allowed to make a transfer. But it says 2 hours before the payment, you need to introduce the beneficiary. I have another bank that says, go ahead, make your payment, fill up the form. Is this a new beneficiary? I say yes. Do you want to save him for the future? I say yes. And it makes the transfer. There is another bank that I used to have, which used to say, you will get 24 hours later from us your approval for a new beneficiary. So if I had to make an urgent payment to anybody, I couldn't. All three are good name banks. All three are seriously good banks. They have all come up with their control. So when setting their risk appetite, they have looked at what is the necessary control. Now here is the challenge from an op risk perspective, and I'm taking Sahar's line, is you have to get in and understand the business if you're in risk and compliance.
Yeah, that's, sorry. Yeah, this point was challenged with the business. You know, we have so many fights with business about these things.
Yes.
Yeah, because the business wants, the name of the bank will be the best and the fastest, and we're looking for the risk. So these one of the points we cannot argue with the business.
So you cannot argue with what? I'm sorry, what is it that
about the timing? If I make a new beneficiary,
yeah,
okay, I can do the transaction in the same day, in the same amount moment. But yes, but for us as a risk, no, we want just to check this beneficiary. So we have to take another process. So we can check in the same day, and the time he already put or input the information. We have to manage if this beneficiary is
okay.
It's okay, or it's one of the blacklist on our side. So
yeah, if it's a name like Vijay it's on your blacklist.
Yes, yes.
I'm going to say this. If you had a choice, I'm asking, of these three banks, immediate transfer, 2-3 hour delay, 24-hour delay, as a retail customer, what are you likely to do? You are most likely, other things being equal, to choose the bank that allows you straight through. That is the most convenient. Everybody is now in this short span of attention. We like to do things. The newer generation, even more so, and by newer, I mean younger than me. Now, as you want to do that, what is happening in the background? You really got to assess the risk, to Sahar's point, understand the business. There is market pressure for you to do this quickly. At the same time, what are the parameters that you need to do? Do you have to stop the payment? Can you do the check afterwards? But he sees the payment having gone. You make the payment 2 hours later physically, but he gets that instruction is through, and it will take, he's not expecting the money to reach in a minute. But that's one way. The other thing banks do is a materiality concept. So if these are small payments, they're saying for that, we don't want to waste time. If you lose 1,000, the bank will either make it good for you or will make efforts to get it back. But $1,000 of a remittance, 1,000 dirhams, 1,000 riyals, you're going to make a payment. Why should I make it so heavy? So operational risk goes in to understand the business, the competition, the viability, the controls that are necessary, the controls that will cost us. So you do a cost benefit, understand the impact, and then say, am I willing to live with this impact or not? Now that's a collaborative discussion where you come up, and if your losses are going to be $1 million, $2 million, you are going to think about that. So every day you break, if once in 6 months you break a dinner plate, you don't have a problem. But if every day you are breaking a dinner plate when you're loading the dishwasher or washing the dishes, you have to change your system. So operational risk will get in and do the second line framework check, value add, and the business should see this as something that's enabling them to do business, not stopping them from doing business. It's the same thing with exchange houses, and I'll just have a quick thing. With exchange houses, there's been a lot of questions about whether you can. The dollar businesses were always a problem. But once again, the analysis is on what is the risk, what is the size of risk, and a lot of people, how do you articulate your risk appetite? I am willing to lose so much money in a year because mistakes will happen. You take risk. By definition, some risk will materialize. But are you making much more money than the risk that's likely to materialize is then the decision-making parameter. There are people who work on fines. We must not have so much in fines or more than so much in fines. And they work around that thing. Does that make sense, or are there any immediate questions? Because I need to then get to the questions on the chat. Any questions on our last discussion? Immediate?
I believe, Vijay, we need to be in this framework of the governance body, basically, any of the regulators, whichever region you are in with.
Yes.
So that would be your primary thing. Secondary, as you rightly said, it's more of a risk appetite. Again, to what extent the bank is ready to take a call on how much exposure you're ready to face. Risk and reward is another thing. It's, as you rightly said, it has to be within the risk and reward function. Without risk, there is no return. So
when you say exposure, what do you mean? That like how much exposure? What is exposure for you?
Exposure is, yes, this is the extent where you might give an example around $1,000. This is the extent where I can take that type of a leap, either by covering myself with an insurance policy, or again, you're backing up with certain mitigating factors where you can cover your losses as well. Not necessarily every day you will face losses. Then if you start facing that, you have a risk assessment which will say that, okay, this is the place where you're facing an issue, address it immediately, right? So the risk assessment also came into picture, or your mitigating factors also will continue guiding you where you need to put your energies on.
So thank you. You have taken us through absolutely the options on how you manage risk. One, you don't understand it, avoid it. If you can't understand about it. If you think it's too big, mitigate it so that the risk becomes smaller that you are likely to suffer. If you think somebody else can do it better, transfer it. So you take insurance or you outsource, you transfer the risk if somebody else is better at doing it than you are, and therefore the risk of losses are lower. So you manage, you mitigate, you transfer, you avoid. There's all of these options in a classic textbook, right?
Yeah, absolutely. You need to take these decisions based on your needs and at that point in time, or the nature of business what you are approaching. You cannot take everything together. Again, it depends upon the nature of the business what you want to try to do.
Right, absolutely. So now I'll come to sort of like a summary slide, and I'll start answering these questions with the help of that. Sorry, just 1 second. I need to. Are you able to see the slide? Just a quick thing is.
Not yet, Vijay. I think it should take a few seconds.
I am just out of.
Yeah, we can see it now.
Yes.
Thank you. So one of the things is, how do I get executive buy-in? Fahim, I'll finish that. So first of all, is all of this risk management an art or a science? And I know we're coming, to the time, this thing. Malavan, how are we okay for a few minutes?
Oh yeah, we are fine. I'm always fine. I'm the organizer. I'm fine.
So is it an art or a science? Clearly, if risk management was a science, by now we would have all the answers in place after all these years. There's a huge element. This is an art. This is really something which goes beyond just numbers, and it is extremely complex. But we have always made the mistake of trying to solve complexity with more complexity. So a lot of black box models, because we always thought that the answers would come in complexity. While they have helped us understand one more aspect, over-reliance on the science or the maths is not a good idea, right? So at the end of the day, it still boils down to people, etc. So Fahim, looking at how you could try and get executive management, because clearly the whole thing has to start at the top. The messaging has to start at the top. So first you've got to simplify and demystify the framework. And that includes the taxonomy. You have to have, because if the business people or the front line or the first line is not talking the language you use, or you are not using the language they use, you have a problem. And this doesn't matter whether that's your wife or it's the first line and the risk management. It's the same thing. If you don't speak the same language, you're in trouble. Then when you do that, go back to the basics. Don't dive in and try and talk all about the complex models and scenarios and a lot of those things. Go back to the 4 definition ingredients and look at how you mitigate them. The discussion we just had with Chandra and some of the questions you've raised, it's really important that we understand. So for example, this could just be if you take certain types of risks like AML or regulation or the pandemics, these are external events. You take fraud, you take some of these are people related. Understand the primary drivers to these things, address those drivers. And you have to get to this level of simplicity. In ABN AMRO, when I set up there was a new risk management unit set up to look after transaction banking. Transaction banking was a $5 billion business, 63 countries. In the beginning, and it never had risk management directly sitting there, they created this department. In the first 12 months, we had over 100 presentations to the business. 100 presentations to explain to them in simple language, to understand from them what they expect from us. That was the level of engagement. It took us 18 months before the business stopped viewing us as spies for risk management and actually people who were helping them earn more money. That was the transformation point. When we were able to get them approvals quickly, when we were able to understand their compliance or complicated documentation requirements for trade finance or a payment timing issue, that's when they realized that we are actually opening doors. So what was that? It's about business knowledge in risk and risk awareness in the business. Cannot overemphasize this. Good organizations move people between the two to make sure that that is a direct solution to language problems. You start to speak common language. Then you synthesize business and risk strategy. If your business is taking risk, why is the business strategy document not a risk strategy document? Because if you have 2 documents, one says, I will do this, and the other one says, you will not do this, you are set up to fail. So the day we start to look at it as not 2 sides of the coin, but one coin, where basically every business activity I want to do brings with it risks, and I am able to demonstrate as a business owner what I'm going to do to manage the risk, is your ideal situation, is when you have a working proposition. And then alignment versus diversity. In all of the Middle Eastern banks, recruitment is from many other banks. It is just the churn is high. People join from multiple cultures. They come in with different words in their mind, different ways, different organization structures. And as long as you have that dichotomy, that adds to the confusion. So the sooner people are conditioned to that bank's way of doing things, that bank's philosophy, and why it's relevant for that bank, the sooner you're able to run. Otherwise, you will have a lot of issues. And what binds all of this is another massive topic, which is risk culture. Not a subject for today, but ultimately risk culture, a learning culture, the culture where you want to do the right thing. You don't always have to get it right, but the intention of doing it right has to be leading. And if your risk culture is correct, and this is my submission to you, what I have always said, compliance is a consequence of good risk culture. Compliance is not in itself something that should be beaten up again and again. It should become a natural outcome of a good risk culture. Does anybody want to challenge me on that? Because that's the end of my presentation. I'm going to skip out of this. This is just a quick thing. We will be running some classes afterwards in September because the subject is so vast, and I know an hour discussion is never enough, but we'll, Malavan can share more of that as we go. I'm going to, if you allow me, just tackle a few questions I have with me. So Fahim, are you okay? So the operational risk in the eyes of executive management is really, executive management includes the chief risk officer. So first of all, he, as part of that team, has a job to do. Secondly, the rest of the executive team has to see risk as useful as something that's enabling them to make money or enabling them to do things better, whether it is direct revenue or decisions on corporate social responsibility, whatever that is, risk management has to be collaborating in all of these things, not challenging as their role is not control only, it's enabling. So that's the only way to get executive management support and buy-in. So whenever we used to go and say, we need some money for this, they say, oh, risk management's asking for money. We had to convince them that you won't be able to run your business properly. You can't make these payments. You can't check these approvals quickly. So you won't be able to make fast payments if you don't have this system in place. So get them to see these systems as business enabling systems and not risk systems. And it's not a play on words. It's truly how you believe what you are doing and whether you are enabling the business. I have a question here. Was COVID-19 a black swan event? I am going to duck out of that question as a number one, a difficult one, very time consuming and a bit outside the scope of what we're doing today. I will endeavor to have a side discussion with you, Sibu, separately sometime. But as a black swan event, well, I mean, I wouldn't even know where to start for now. So if you allow me to let that go for today's event, it doesn't quite fall into what people have signed up for. Is that okay? Yeah, but I will try and get in touch with you after this. Then we have bank is a custodian of trust and need to manage it. What's the most important thing as per your, the definition of op risk and risk tools, and why? Because obviously all are important. I think, so, as a custodian of trust, as an enabler, I think you are kind of putting the answer in the first part of your question. That is the most important thing. The tools that you use, you can't say which is the more important tool because each situation, each bank will need a certain approach. Now, certain tools like risk self-assessments are renewable use tools. There is a time and a place and you need to renew your awareness. You will use them again. But loss analytics, etc., are more incidental, event management, more incidental. And, I can only hope you use it less and less, but the ability to pick the right tool to come up with the best result, which the business understands and shows it what to do to move forward, is the right tool. If I can answer this differently in my career in op risk, if I look at, at ABN AMRO, when we were looking at transaction banking, all operational risk, when the RBS took over ABN AMRO's transaction bank business, I was the head of operational risk globally for RBS. At that point in time, the first few months, there was frantic activity on tools and definitions and educating everybody about the tools. And it was almost as if the tools became more important than what you were doing with them. Now, this was partly because of the takeover and merger, but at the end of the day, we actually started to sit down and say, what is the problem? What are we solving for? And what is it that we can use with the business to come up with the quickest, best answer? And then we would choose the relevant tool. So never let the tools take over your life. It is, at the end of the day, the basic mitigation techniques to the definition of people, process, systems, and events. That's your number one tool. And then for the rest, you need to choose based on the event. Open to more questions.
I just want to add something. Maybe we can consider this for a next seminar or something.
Please.
Now, for the 3 lines of defense as defined by operational risk management, those definitions go back to, maybe to 1990. They were developed over time. Now we have the we have the newly developed governance principle on 3 lines of defense with audit, compliance, and risk management. Now, the risk management most likely be the operational risk management, which in their lines of defense include audit and compliance in the second line of defense. So this is kindly creating kind of conflict, conflict of a power or some sort of dictatorship from risk management, given the emphasis given to it in the recent days.
Okay, and I think just for those who may have lost out a bit of that, so this is about suggesting another more elaborate discussion on the lines of defense as it has evolved, because 3 lines is an older concept. One is who is the second line of defense for the second line of defense kind of challenge. And now central banks are introducing a 4 line of defense concept as more appropriate. So your point, very valid and taken, Imad. We will think about that with Malavan. An extended discussion on how to look at lines of defense, just focusing on that at the challenges there. Is that okay? Any other questions from the audience, please?
Guys, we are getting closer to the end of the session. Another 15 minutes, it will be a fully fledged training program. Please feel free to ask your question before we end up.
Yeah. No, I kind of appreciate the discussion and some of the challenges and questions and suggestions that have come. And it's always far more useful because there is a very diverse background, if I can say, in the room at the moment. And it does help. So thank you for provoking some of those ideas. And the more disruption there is in a presentation like this, the better for you, for me at least. I find that a far healthier way of discussing. You address needs. So that's my thank you for your contribution today. And I'll put out any last calls for questions. Malavan, I think that's back to you.
Yes. Thank you very much for joining. Yes, please go ahead.
I just want to say thanks, Vijay. It's very inciting and very fruitful. Thanks a lot.
No, I appreciate your question. Thank you, Imad. Yeah.
Thank you, everyone, for joining us. I hope we enjoyed, definitely we enjoyed. We hope that you have enjoyed this discussion. There are more similar webinars, discussions. Thank you. I think that's an appreciation.
It's me, it's my children. Sorry.
Hey, don't worry. That's all right.
I just want to thank you all. I really enjoyed the seminar.
Amna, I have a question. I have a question.
Yes,
Can I give you a test for children now?
For?
Can I give you a quiz for the children on Operation?
For the children, I think yes. But I'm not sure they will pass.
Okay.
Thank you all. I really enjoyed.
And Thibu, I will get in touch with you.
Inshallah.
Very good. Fahim, the brochure should be ready by next week. So as soon as it's ready, we'll email the brochures for the 3 courses that we have planned before the end of the year on operational risk. Okay. Thank you, everyone. Probably by tonight or tomorrow, we should share the recording of today's session. Some of your colleagues may, probably they could not join today.